Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of the importance of capital budgeting for business success. Payback period method. The payback period method is one of the simplest ways to evaluate an investment. It calculates how long it will take for a project to recover its initial cost. Think of it as figuring out when you'll break even. The formula is straightforward. Payback period equals initial investment divided by annual cash inflows. For example, if a company invests $50,000 in a project that generates $10,000 per year, the payback period is 5 years. Advantages. Easy to understand. Even those without a financial background can follow this method. Quick results. Helps businesses make fast decisions. Risk assessment. Projects with shorter payback periods reduce exposure to uncertainty. Limitations. Ignores cash flows after payback. You miss out on assessing long-term profitability. Doesn't factor in time value of money. $1 today isn't the same as $1 5 years later. This method may be ideal for smaller projects or decisions where speed is key, but it's not the best for evaluating overall profitability. Net present value, NPV. The NPV method evaluates an investment by calculating the present value of future cash flows, adjusted for the time value of money. Here's the formula. NPV equals sigma, cash flow divided by 1 plus R, caret T, initial investment. Where R is the discount rate, cost of capital. T is the time period. If the NPV is positive, the project is expected to generate more value than it costs, making it a good investment. Why it's preferred. Incorporates time value of money. It accounts for the declining value of future cash. Focuses on profitability. A positive NPV guarantees that a project adds value. Compares multiple options. Businesses can rank projects by their NPV to prioritize investments. However, NPV requires choosing an accurate discount rate, which can be tricky. Small changes in the rate can dramatically shift results. Still, it's widely regarded as the gold standard for assessing project viability. Internal rate of return, IRR. IRR calculates the discount rate that makes the NPV of a project equal to 0. In simpler terms, it tells you the project's expected annual return. Here's the general idea. Find the rate, IRR, at which sigma, cash flow divided by 1 plus IRR, caret T, equals initial investment. When comparing projects, the one with the higher IRR is typically the better choice, assuming other factors are equal. Use cases. Great for measuring profitability in percentage terms. Helps businesses compare projects with different costs and cash flows. Useful for understanding the break-even cost of capital. Potential challenges. IRR can be misleading for projects with unconventional cash flows, e.g., alternating signs. It doesn't always align with NPV results when projects vary significantly in size or duration. Despite its flaws, IRR is highly popular because it provides a clear, percentage-based measure of returns that's easy to communicate. Profitability Index. The Profitability Index, PI, helps measure the value generated per dollar invested. It's a simple ratio. PI equals present value of cash flows divided by initial investment. If PI is greater than 1, the project adds value. A PI of 1.2, for example, means you gain $1.20 for every dollar spent. Why it's significant. Prioritizes efficient use of funds, especially valuable when capital is limited. Balances cost and return. Ensures investments are worth their expense. Works well for ranking projects. Higher PI values indicate better opportunities. One downside is that PI can overlook the scale of a project. A large, lower PI project could still generate more total profit than a small, high PI one. Despite this, PI is invaluable for businesses facing budget constraints. Modified Internal Rate of Return, MIRR. MIR is an improved version of IRR. It adjusts for some of IRR's limitations by assuming reinvestment at the project's cost of capital, not its IRR. Here's how it works. Calculate the future value of positive cash flows based on the reinvestment rate. Calculate the present value of costs based on the finance rate. Find the rate, MER, that equates these two values. Benefits over IRR. Eliminates misleading results. Handles irregular cash flows more effectively. Realistic reinvestment assumption. Uses achievable reinvestment rates. Easier decision making. Aligns more closely with NPV for consistent results. MER is a powerful tool for companies seeking a more accurate comparison of various investment choices, especially for projects with complex cash flows. Each method has its place, depending on the project type, company goals, and available resources. By combining these techniques, businesses can make smarter, well-rounded investment decisions tailored to their unique needs. Steps in the capital budgeting process. Capital budgeting involves several key steps to ensure businesses select the right investments. Each phase builds on the last, guiding decision-makers toward projects that maximize returns while managing risks. Here's how companies approach this essential process. Project identification and evaluation. The first step is identifying potential projects. This involves brainstorming, research, and listening to ideas from various teams. Projects might range from launching new products to upgrading outdated equipment. Once you've compiled a list, it's time to evaluate each option. Ask yourself, is this project aligned with the company's goals? Will it provide measurable benefits? Feasibility is also vital. Great ideas that are too costly or complex may not be worth pursuing. Key actions include defining objective, clearly outline what the investment aims to achieve. Analyzing market demand. Is there a need for the product or service? Preliminary cost estimation. Roughly calculate the resources required. Not every idea will make it past this stage, but thorough evaluation ensures only the most promising projects move forward. Cash flow estimation. Once a project's potential is confirmed, the next step is predicting its future cash flows. This involves looking at all the revenues and costs it will generate over time. Why does this matter? Because no investment is worthwhile if the cash inflow doesn't exceed the outlay. Accurate estimates are essential for painting a clear picture of a project's financial performance. How can businesses forecast cash flows? Use historical data from similar projects as a guide. Consider market trends and industry conditions. Break it into operating cash flows, day-to-day activities, and non-operating cash flows, equipment resale, tax benefits. Cash flow estimation is like piecing together a puzzle. Every detail, no matter how small, plays a role in seeing the full picture. Get this wrong, and the entire budgeting process could falter. Risk assessment and analysis. Every investment carries risk. The goal here is to pinpoint possible challenges and measure how they might affect the project. This step allows businesses to prepare for worst-case scenarios while identifying opportunities to minimize uncertainty. Key risks include market risks. Could demand dip unexpectedly? Financial risks. Will funding be sufficient, or are there better alternatives? Operational risks. Could delays or technical issues impact success? One commonly used tool is sensitivity analysis. This technique adjusts variables like cost, revenue, or interest rates to see how outcomes might change. Think of it as stress testing your project to ensure it can weather different situations. Businesses that account for risk upfront are better equipped to handle hiccups, giving them a clear edge in the decision-making phase. Decision-making. At this stage, all the gathered data comes together. Decision-makers evaluate whether the project's benefits outweigh its costs and risks. This is where capital budgeting frameworks, like NPV or IRR, prove invaluable. A good decision-making process involves ranking projects based on potential profitability and risk levels, comparing options using quantitative tools, NPV, payback period, etc., considering qualitative factors like employee impact or brand value. The outcome? A confident yes or no. This isn't the time for guesswork. Decisions should be based on evidence-backed analysis. The selected project moves forward with implementation, lining the company up for long-term success. By following these steps, Businesses can systematically evaluate investments, making informed choices that align with their goals and resources. Stay tuned to continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.